Elon Musk has always been known for making big bets, and his latest one revolves around autonomy. The chances of success for Tesla's self-driving technology have increased slightly, but the key question for investors is, how much of this growth is sustainable? Looking at the numbers, if Tesla captures 50% of the US ride-sharing market by 2030, something that seems achievable, that alone could boost the company's operating income by about 20%. Given that the stock has already risen 15% recently, this potential growth is already being factored in. Tesla can also expand this model to other regions, but a lot of future potential has already been priced into the stock. One aspect that may not be fully accounted for yet is Tesla's planned robotaxi fleet. Elon Musk has mentioned producing 2 to 4 million robotaxis per year, though a more realistic estimate would be around 1 to 2 million. If Tesla successfully integrates this into its ecosystem, it could add another revenue stream that hasn't been fully appreciated by the market. Beyond Tesla, Musk's broader ventures are also benefiting from recent developments. SpaceX, for example, could gain from potential policy changes that may extend tax credits for EVs longer than expected. And then there's X, formerly Twitter, which continues to evolve under Musk's leadership, with the potential to grow further in an era that values open discussion. That is another area where Musk is making moves. The regulatory environment for artificial intelligence remains uncertain, but with XA recently securing significant funding, Tesla could see additional upside from advancements in AI-driven automation. At this point, it's difficult to see a scenario where Musk's empire doesn't continue to expand. Despite the many ventures he juggles, Tesla investors seem comfortable with the fact that he's only dedicating a limited amount of time to each one. His track record speaks for itself, and as long as he remains visible, especially on earnings calls, investors will likely remain confident. Now, looking at Tesla's financials, the company has provided guidance for 2024, indicating slightly higher deliveries than the previous year. This suggests about 10% growth for the December quarter, while Wall Street had only expected around 1%. That was an unexpected positive surprise. However, profitability was another story. While Tesla reported an auto gross margin of 17.1%, part of that was due to one-time benefits from Cybertruck and full self-driving (FSD) revenue recognition. The earnings call should provide more clarity on how much of an impact those factors had. A major question remains about Tesla's upcoming vehicle lineup. While there's speculation about a new, more affordable model, the company has been strategic in holding back details. If they reveal a new model too soon, it could hurt current sales. Most analysts now believe Tesla will modify the Model 3 rather than launch an entirely new platform in the short term. The cost side of the business is also critical. Tesla has reduced its production costs by 6% year over year, while average selling prices have dropped by the same amount. This efficiency allows Tesla to maintain profitability, while legacy automakers struggle to make EVs at scale. The key concern is China, which accounts for about 15 to 17% of Tesla's total unit sales. Growth in that market has been a challenge, and improving Cybertruck production efficiency could help offset some of those issues. Despite Tesla's impressive cost-cutting, deliveries were down 9% in the most recent quarter. This is concerning because the market had been expecting 15% delivery growth for the year. If Tesla can only manage 10% sequential growth in the coming quarters, deliveries could actually decline by 3% for 2024. That's why analysts are reassessing their price targets, and some are even calling for a significant pullback in the stock. Long-term, the EV industry is still poised for massive growth. The global auto market is worth around $2.5 trillion annually, and while the transition to electric vehicles has slowed in some regions, it's still happening. One reason for recent demand softness is that early adopters rushed to buy EVs sooner than expected, pulling demand forward. That created a temporary dip in growth, but the long-term trajectory remains intact. A critical piece of Tesla's future lies in full self-driving. The latest version of FSD Beta, released just last week, represents a major leap forward. If Tesla can continue improving FSD at this pace, it could become a significant catalyst within the next couple of years. That brings us to Tesla's next big move, robotaxis. Musk has hinted at a late 2025 launch for these vehicles, but investors should approach that timeline with skepticism. Tesla has historically set aggressive targets, and the reality is that achieving full autonomy at scale will take time. If they manage to roll out a limited robotaxi service in select cities, it would be a step in the right direction, but widespread adoption is still years away. Another possibility is that Tesla introduces multiple new vehicle types. A lower-cost Tesla is a strong likelihood, but there's also speculation about a larger vehicle, possibly a van designed for autonomous ride-sharing. If Tesla captures a significant share of the ride-hailing market, the financial impact could be meaningful. By eliminating the need for drivers, Tesla could offer rides at a lower cost than Uber while taking a similar commission, adding substantial high-margin revenue to its business. In the short term, Tesla's stock could remain under pressure following upcoming announcements as investors digest the timeline for new products. But looking further ahead, Tesla's revenue growth could re-accelerate to the 20 to 25% range. If that happens, and Tesla trades at a valuation similar to tech companies like Apple, there's potential for the stock to be 40% higher over the next couple of years. Affordability remains a key theme for Tesla. If their next vehicle is simply a cost-reduced Model 3, margins should hold up well. But if it requires an entirely new factory and platform, it could pressure margins further. Either way, the focus is shifting from margins to delivery growth. Investors now want to see Tesla scale production efficiently while maintaining its technological edge. Ultimately, Tesla is positioning itself not just as an automaker, but as a tech company. The advancements in AI, robotics, and autonomous driving reinforce this narrative. Musk's vision for the company extends far beyond cars, with potential applications in insurance, HVAC systems, and even flying taxis, though that remains highly speculative for now. At its current valuation, Tesla is already a trillion-dollar company, but looking ahead, it could become a $2.5 trillion business within 5 years. If revenue scales from $70 billion to $400 billion, and Tesla maintains a multiple similar to other hardware-software service companies, that equates to a stock price of around $2,500. Tesla's story will continue to evolve, and as it moves beyond traditional auto manufacturing, new opportunities will emerge. While short-term volatility is likely, the long-term potential remains compelling.